Okay, so welcome back after the break. We've devoted some time in the lecture before the break to comparative advantage, comparative versus competitive advantage, and I started a little bit with this idea that money prices can make it a little bit difficult to ascertain which country actually has a comparative advantage in something. Now, in order to try and explain that, I hope this is a little bit visible because the beamer seems to be running on its last legs, as they say. If you take a look at this box, and if you printed the handout, then you'll be able to see it a little bit more clearly. This represents equation 3-4 in the course textbook, the new one. And what this equation tells you is that for comparative advantage to be visible in the sense that on world markets, the prices will allow a country's comparative advantage, as it were, to show through, then it is necessary that the relative wage, that's the wage in the Eurozone divided by the wage, in this case, in the USA, has to be within certain limits. And if you take a look at what they tell you in the book, the numbers, which are, by the way, based on the exact same data I was using in my presentation earlier today, then the book will explain to you that the wage, the relative European wage, has to be less than a half and greater than 1/6. Now, this spreadsheet, and I really urge you to download it and fool around with it a little bit because you can change the numbers and see what's going on. But just to orient you in using this spreadsheet, this relative wage also appears here because that number is the European wage divided by the US wage. And also, this 1/2 and this 1/6 are also in this spreadsheet, 0.5 and 0.17. And again, by fooling around with the numbers, you can actually see these things and how they relate to another. But what's important is to see that this and this, those limits, are basically the relative productivity of Europe. Now, before I continue, I told you before the break that the book doesn't use an exchange rate. This spreadsheet has an exchange rate explicitly in it, and you can see it here. I've set it equal to 1. And you can see it in the equations here, or the numerical results, as being set to 1. If you want, you can also fool around with the exchange rate, but for the time being, just assume it away. Okay? Now, what does this mean? What's the intuition about it? The relative wage, here it is, has to be in between Europe's relative productivities. Well, just think in your mind's eye a little bit, yourself. Assume that you and an acquaintance of yours are trying to make money by, mowing lawns in the weekend or whatever. And you're in competition with each other because you both want to make some money to go on vacation. And you've been doing it a long time, so let's just, for the sake of argument, say you are twice, your relative productivity compared to your friend, your productivity is twice as much, so your relative productivity is 2. You can mow the lawn in half the time or do twice as big a yard in the same time, however you want to think of it. Now, you go to a house, and you both are there and you want to mow the guy's lawn. Now, think about it, it's not hard, but if you were to ask a wage which was equal to your friend's, and the guy who wants to hire you knows this, he's going to hire you right away, right? Because he knows he's paying the same money and getting somebody who's twice as productive. If you were to then say, well, give me 1.5 times the wage of this friend, then it'll still be in the interest of the guy to hire you. And you know from your basic economics and market equilibrium that you could actually, if your productivity is twice as high as your friend's, you'll be able to ask for a wage exactly twice as high, and then it'll make the guy in the house indifferent between you. Because whether he pays you, let's say, €2, and you get it done in 1 hour, or he pays the other guy €1 per hour, it takes him 2 hours, but you're still paying €2, right? Who cares? What you would be very dumb to do was say, I want €10 per hour. Because by asking for 10 times as much as your friend, while you can only work twice as productively, then the guy in the house, of course, is going to say, no way. And what's the bottom line of this very obvious, intuitively very sensible story? If you have a relative price which exceeds your relative productivity, then sooner or later people are going to realize you're no good. They're not going to use you. Right? Now think of it the other way around. Let's say that you are twice as productive as your friend, and you ask for only half the wage or half the money. Then, of course, everybody will buy from you, right? Will want you to mow their lawn. And assuming that you are out there to maximize your income, you'll start thinking about yourself. You'll start wondering, why are these people, if you're too dumb to realize it yourself, why are these people all hiring me? And the answer is because, you're a bargain. You're twice as productive, but it costs less, so your wage will go up. So if you think about this in the context of our story here, what it boils down to is this. If the country's relative wage is higher than what it does most productively compared to the rest of the world, then it's priced itself out of the market. Right? If its relative wage is lower than what it does relatively worst, then it'll, in a matter of speaking, have priced itself into the market because everybody will want to buy from you. But since markets respond to excess demand and excess supply, if the wage were to be lower than this lower productivity, then everybody in the world will buy everything, in this case, from Europe. And if the wage were to be higher than the maximum productivity, then nobody in the world would buy a thing from Europe. And if the wage is in between somewhere, then it's okay. There's no unique value. It has to be within that limit. The minimum would be 0.17 in this case. The maximum would be somewhere in that range, right? What happens is that you are priced out of the market for the expensive good, but in for the cheap one. Let me erase this for a second and ask you now to just think about this in the sense of assume that this country with these productivity values, and when you watch this video, have that spreadsheet next to you on the screen, so you can fool around with the numbers. Let's say that the wage in Europe were lower than 0.17. What do you think is going to happen? Well, I already told you. Then everybody in the whole world will buy cloth and wine from Eurozone. But what is that going to do to market prices, wages, exchange rates? And the answer is very obvious. If everybody wants euros, if everybody wants European cloth, if everybody wants European wine, and the reverse side of the story is nobody needs dollars, nobody wants US cloth, nobody wants US wine, what do you think is going to happen on the markets? Well, in Europe, there's going to be an enormous demand for labor because of all that demand for cloth and wine. So wages are going to be bid up. And we started below 1.7. So if the wages are being bid up, you're going to start approaching that lower limit. But let's say, for the sake of argument, that wages are fixed due to unions. Right? how else can European prices start to rise if wages are fixed? And the answer is, of course, that thing that's missing in the book, but the exchange rate. Because if everybody wants to buy European cloth and European wine, then everybody in the world is going to need euros. And so everybody is going to buy euros, and that means there's going to be excess demand for euros, and the price of euros will go up. Now, the crucial thing to see is that if you start out from a situation where on the world market, which in the spreadsheet is given down here in dollar prices, Europe is cheaper in everything, then there are going to be forces at work increasing the wage and thereby increasing the price in Europe, increasing the value of the euro, or both, until it turns out that we are again above that lower limit. In that way, markets allow, as it were, the comparative advantage to come through. Now, let me see if I can actually get a spreadsheet online here. What we see here is the spreadsheet I just showed you, but this is the real spreadsheet. Let me just, for the fun of it, increase the wage in Europe a lot. And what you see now is here the relative wage is 0.95, which is, of course, greater than 0.5. And if I take a look at this table, which gives the prices in dollars, then you can see that the European Union is now outcompeted by the US in the cloth sector, because cloth costs $0.95 if you buy it from Europe, but only 0.17 if you buy it from the US. While if I take a look at wine, a gallon of wine costs 0.48 in Europe, but only 0.25 in the US. So everybody, like I said, will go to the US to buy the stuff. That means nobody will buy from European firms anymore. And obviously, here the arrow already gives it away. In order to go back into an acceptable range, that wage rate is going to have to go down. And you can see, if you look at this table, that as that wage rate goes down, right, the price of European goods goes down. And if it goes down too much, right, now take a look. Now the European goods are cheaper across the board. Now everybody would buy from Europe, but that would make the wage go up again until it's within the limit. Now, what I said the book doesn't show you is that we also have an exchange rate. So that if in Europe wages are very high, pricing the Eurozone out of the market, and if, for example, wages can't adjust in the Eurozone, we can still have an adjustment if the exchange rate falls. And just because you can do this yourself, that either the wages or the exchange rate or both are going to have to adjust. Now let me show you something about how you can use this very simple example to take a look at some of the topics which are current in today's international economy. This is basically the same story, the same numbers, but what I've done here is instead of Eurozone and China, Eurozone and the US, I have China and the US. We see that we, in this case, have the Chinese comparative advantage in wine appearing on world markets, and we have the US comparative advantage in cloth also appearing on world markets. But we all know that over the past decade, 20 years, there's been an enormous growth in productivity in China due to the reorganization of their economy and all that foreign investment which has introduced new technology. Labor productivity has gone up. Well, let's see what that would mean. That would mean that maybe the productivity has increased tenfold, and it's now that instead of 1 and 2, Chinese labor can produce 10 cloth and 20 wine. Notice what that does to the U.S. Right? That increase in productivity with unchanged wages and prices has made the U.S. completely uncompetitive. Chinese dollar prices on world markets are much lower for both goods. How can we return to a situation where the country's true comparative advantage shows through? Well, here, the wage in China will have to go up, or the value of the Chinese currency, the renminbi, will have to go up. And the problem, which is causing the international tension, is that China doesn't want to do either one. They don't want wages to rise because that leads to unwanted income distributional problems and inflation in China. And they don't want the value of their currency to go up because they don't want to lose competitive position. Right? So either the wage has to go up or the value of the Chinese currency has to go up, but that's neither possible. Now we have Greece and the European Union. And we start off with a nice equilibrium. But now assume that in the course of time, due to bad economic management, corruption, whatever you will hear about or read about in the papers, that the productivity in Greece has gone down. And again, as an extreme example, let's say by 1/10. So that means instead of 1, this becomes 0.1, and instead of 2, this becomes 0.2. And now you notice that Greece has completely priced itself out of the market. Right? What can Greece do to let Greece's comparative advantage again appear? Well, the wage expressed in drachma, or whatever, right? Greek euro, if they had their own money, the wage could go down. But of course, nobody wants the wage to go down because that's their income. Well, if Greece wasn't in the Eurozone, and if they did have their own currency, the drachma, for example, then they could devalue. But unfortunately, they're in the Eurozone, so they can't change the exchange rate. That means the only way for Greece to reappear on world markets or EU markets in a way that their comparative advantage goods are sellable is if the wage in Greece goes down by quite a bit. And we all know and see and read the troubles which that causes a country. And it's all because of this relationship between productivities, comparative advantage, opportunity costs, and in this final example, also how money and markets can mess things up. Final comment. It's also mentioned in at least the new version of the book, but you can think about it. This is all international trade. But another important topic in the course is international investment, multinationals. Now, if you're a firm and you're imagining where do I want to invest, where do I want to set up a plant, you're going to be looking at not necessarily a country's comparative advantage, but you're going to look at how the country can feed into your competitive position. Now, the problem is that assume now a country with a very low wage level and a very low currency value. In other words, a country that you know if I put my factory in there, I'm going to be able to export to world markets at a low price. Is that going to be a good idea? It may be a good idea in the short term because major changes to a country's economy and its international financial position take time to change. But as long as the country has very low wages and a very cheap currency, it might make very good business sense to set up a factory there. The problem is, think about the longer term. What I just explained to you, about how a country with very low prices and very low currency value will see pressure for all those things to rise. And how we also saw, and you can see for yourself, that when those nominal changes, wages, prices, exchange rates go up, right? The first sector, think about this and listen, the first sector that is going to find itself become uncompetitive on world markets is the comparative disadvantage sector in that country. That means that you as a business, while not maybe your prime concern, might always be smart to think it's a good idea now, but as prices and wages and exchange rates adjust to what's happening in the world, will that country afford my business a competitive advantage? In other words, does that country have a comparative advantage that feeds into my firm's needs, or is it a comparative disadvantage in that country that will finally cause me some problems? The long-term decision is a big difference with regard to the question, does that country have a comparative advantage in what you need or a comparative disadvantage? In the short term, exploit it. But if you're dumb enough or smart enough or shrewd enough or just lucky enough to be able to get into a country with very low wages and very low prices and very low currency value, exploit that and get out before all those prices and wages change due to comparative advantage and globalization, then you've been able to make a profit. But for the long run, the only firm that will stay there will be the firms that invest in the comparative advantage sector. That's how those prices and wages feed into the story. Then we go now to the final topic, this idea of a price wedge. This appears in chapter 1, and it will reappear in a number of different chapters, sometimes with regard to international transactions having to do with trade and investment, sometimes having to do with international financial flows. Before I go into the wedge itself, because it's, again, a graph which appears a lot in the book, I want to go into this idea about export supply and import demand curves. Let's say we have two countries, country home and country foreign. And let's assume away all problems of underpriced currencies and overpriced wages. Let's forget all about money. This is the market for apples, and I'm just telling you that country H has a lower price of apple for apples than country F does. Y is basically unimportant at this stage of the game. These two countries have their autarky price, autarky demand and supply in both cases. What happens when they start trading? And also, how can we determine the world market price at which these two countries will start trading apples? To do that, we first have to figure out how will the exporting country appear on the world market. In other words, what is the export supply that the cheap country will offer? The thought experiment is as follows. Assume that the world market price equals the price in the country. How much will this firm export? And the answer is 0. Because at this price, let's call it P1, the firms are willing to produce 10, the consumers are willing to buy 10. That means there is nothing available for export. Now assume that the price on the world market is a little higher. It's a thought experiment. Right? We are building a menu of choices for this country. If the price were to go up to P2, then we see that supply in the country would rise. That's what firms do. When they see prices go up, they respond by increasing output. And we see that consumers demand less, which is what consumers do when they see the price go up. And that means that we now have a gap, an excess supply at this price P2, and that excess supply is theoretically available for export. And if the price goes up a little higher, supply will go up a little more, demand will go down a little more, excess supply will increase, and therefore the availability of the export product on the market will go up too. These things are just successive thought experiments, and it shows you that on the world market, starting at the exporting country's autarky price, that means when there's no trade, the export supply curve will go up as the world market price goes up. Now, this looks a lot like a normal supply curve, right? As the price on the world market goes up, the supply goes up. But there's one crucial difference, and that is that as the world market price rises, the quantity of exports comes from two sources in the exporting country. It comes from an increase in supply, but also from a drop in demand. Those two things together determine the amount of export, which also explains it's no accident that the export supply curve will be quite elastic. Because remember what elasticity means. Elasticity means how quantity responds to a price change. Well, the elasticity of the export supply curve is the sum of the elasticities of supply and demand, because it captures the response of both on the exporting country's domestic market. We can also do the same for the importing country. I go through this a little bit quicker, right? At the initial price, let's call this P6, right? There is no import demand, because at the price P6, what the domestic firms are willing to supply exactly equals what the consumers are willing to buy, so they don't need the world market. But if the price were to go down, then firms supply less, which again is how firms respond to falling prices. Consumers demand more, which is how consumers demand to react to falling prices. And therefore we have now an excess demand. That excess demand must come from outside the country. Therefore, it represents import demand on world markets. And the lower the price becomes, the more the country will want to import, and we get, in the same way that we saw before, an import demand curve. And here too, we realize that the import demand is the result of two things changing in the importing country: demand going up and supply going down. Well, the next thing is, of course, to combine in one graph the export supply and the import demand curve. And it is this graph in the middle which is what this story is all about, because that graph reappears a number of times in the book. Okay, so it's interesting and important to know exactly what's the story behind it. Well, if we focus just on the center graph, then by now you know that the intersection of the export supply and the import demand will determine the equilibrium trade of this commodity on world markets. Both the quantity and the price will be determined by the intersection of those two curves. That will determine, as I said, the equilibrium world price. Now, what makes the equilibrium price an equilibrium price? When nobody wants to change anything, supply has to equal demand. This quantity down here, given in this orange bar, is the quantity traded, exported by H, imported by F. So that means we can take a look at how that works in the two countries, and obviously the quantity which the importing country imports has to exactly equal the quantity which the exporting country exports. we can also, for the first time, take a look at welfare consequences. Do you remember, I think you do, many of you will, the idea, the concepts of consumer surplus and producer surplus? If I take a look at this area for the exporting country, then you should recognize this as the rise in the producer surplus in country H, because it's the result of the price going up from the no trade price to P star. So the firm increased its output and it received a higher price for everything. That purple area is therefore the increase in the producer surplus. It's a plus. It is a positive contribution to welfare in country H. Unfortunately for the consumers, they lose. Right? This area is the fall in consumer surplus. And again, it's obvious why it's a negative thing for the country, because the consumers, compared to before trade, they consume less of this product, and they pay more for every unit they still consume. So they are definitely losing. This area represents the positive producer surplus. This area represents the negative consumer surplus. And eyeballing the graph, you can easily see that the producers gain more than the consumers lose by that triangular area. That means that the home country has a net welfare gain thanks to exporting this product. On the world market graph, this triangular welfare gain is represented by this triangle. Remember the geometry, same base, the quantity of exports, same height, the change in price. So base times height times 1/2, same triangle. Okay. So it's interesting to show in this way that the country that exports has a net gain. What about the importing country? Well, here it is. This area, which isn't in the graph, but I'm drawing now, is the fall in producer surplus in the importing country. The reason is that the producers produce less, and for everything they sell, they get a lower price. So that's a loss. The consumers have an increase in consumer surplus by this area. And again, the reasoning, consumers have more to buy and they pay less for it. The consumers in the importing country gain more than the losers lose, which means that the importing country also has a net gain, and this triangle and this triangle have the same size. Combining those two findings, and again, thinking in the context of a simple model where it is a two-country world, country H and country F, then we see that moving from no trade to trade increases welfare in both countries, which on the world market is represented by this big triangle, the sum of two different triangles. This represents the total increase in world welfare due to international trade. Using this graph, which is a sort of a lead-in to a topic which is going to be discussed more, well, a little more detail later. But what we see here in this graph, the quantities, the prices, the welfare changes, right? They are all the outcome of undisturbed markets in our simple model. It's the idea of markets allowing the willingness of people to pay for something. You can think of marginal utility equal to marginal cost. It's the Pareto optimum, the welfare maximizing outcome. And that would lead to an export or an import, depending on the country you are looking at this from, of a quantity, let's say 100 apples. Now let's say that one of these two country governments, or both of them, for some reason decide they want to restrict trade. Right? They are going to conduct some sort of policy, which again we'll look at more closely in a later lecture, but they are, you all know that import tariffs and quotas and all sorts of technical regulations, anything can be used by a government as a sort of an excuse to stop international trade. So let's say that the governments succeed in reducing trade to 50. That means that I can draw a vertical line above 50, and that world trade has now been reduced to this red bar. And that means that what the world loses as potential welfare is this triangle here. Right? That additional welfare point, that little triangle at the edge, right? The world could get to it if government were to relax the restrictions and allow markets to work and allow trade to recover its value of 100. But as long as governments don't allow that to happen, there's going to be a loss. This vertical distance between the demand curve and the supply curve, in this case it's for apples or whatever, right? This vertical distance is what in the book is called the wedge. It is something which prevents the efficient outcome from being attained. And at various points in this book, you'll uncover reasons that a wedge prevents this type of efficiency to be realized. And let me erase everything and just draw this little wedge here. Right? You can imagine that the bigger the wedge becomes, the larger the welfare or efficiency loss which that wedge introduces into the transactions between these two countries. And one of the things that you can read in the book about, again, is a sort of a positive effect of globalization, especially in the later chapters of the book, the integration of financial and capital markets, is to be able to reduce transaction costs, and maybe through the World Trade Organization, reduce tariffs and other restrictions, to get that wedge to get smaller, allowing the absolute maximum efficiency and welfare maximum to be achieved. That's basically what the wedge means in the context of this course. Well, if you take a look at the graph now, and I only have time for one example, I'm afraid I'm going to have to test your patience for just 1 or 2 minutes extra. But here we see the graph which we just derived, where we have the export supply and the import demand curve, and we have the optimum volume of trade. And if we forget about the wedge for a minute, we know that this is the world welfare. It's sometimes interesting to see, let me go back here, how changes in countries will affect this equilibrium point. Let's say this is China, and let's say this is the EU, and we import a certain volume of goods from China. Now let's say that due to increasing welfare and income in China, they want more of everything, right? That's what happens when people get richer. They want to consume more. So that means that this product, let's call it an apple, is now desired more by the Chinese consumer. How does that change things on the world market? Well, how does it change things on the Chinese market? We all know that an increase in demand is represented by a rightward shift in the demand curve. That means at that old price, China has less to export, which is very, very logical, right? Because they want to eat the apples themselves rather than sell them to people in the European Union. How does that affect the export supply curve? Well, this blue bar has become smaller, which means that in this graph, the export supply curve will have shifted to the left. And again, it's pure logic, it's simple, right? If they eat more of their apples themselves, there's going to be less available for them to export to the European Union. What do you think will happen to the price if there is less exports? Exports become scarcer, and the world price will rise. Is that good for European welfare? Well, in this very simple model, you could say if a country has to pay more for its import goods, that must be a cost, so that must be a welfare loss. But there's nothing wrong with this. That's just the world evolving. Remember, I started out by saying the reason that this is happening is increased income of Chinese firms, consumers, governments, all trying to do the same thing that we are doing here, namely increase economic growth, increase welfare, and try to do it the best you can. The rest of this slideshow gives you some examples about how that affects the wedge. I recommend you do that for the quizzes, but it's the end of the lecture for today. See you all next week.